We start the conference with a session on the bond market, closed but not quite, because that's one area which everybody finds very interesting. The government keeps on saying that we need a deep, liquid bond market. And I guess infrastructure companies, insurance companies, everybody is very interested in having a deep, liquid bond market, but it just doesn't happen. So we have a fabulous panel to take us through their own experiences of tapping the bond market and also what could possibly make this market work. We have Harjeet Kohli, Group Treasurer, Bharti Enterprises; Nikhil Soni, Vice President Finance, Mahindra & Mahindra; Pankaj Kalra, Head Corporate Finance, Kane India. Gentlemen, please join me on the dais.
I'll take this.
So just in the meantime, Harjeet has served as the Group Treasurer of Bharti Airtel and Chief Investor Relations for both Bharti Airtel and Bharti Infratel. With over 18 years of experience, he serves as a key deal team member for all funding risk, markets and business development activities. And that includes the listing of Bharti Infratel, the Zain acquisition, and Bharti's debut bond. And Bharti since has been tapping the market fairly regularly. Nikhil, on the other hand, as Vice President Finance at the Mahindra Group, heads the treasury function with over 23 years of experience. He's been, in the past, acted as CFO of Mahindra Navistar Automotives and is on the board of several companies. He's also been responsible for India Inc.'s 50-year, perhaps the only bond, 50-year bond by M&M. And that brings me to Pankaj. Pankaj heads corporate finance at Kane India. He has close to 2 decades of experience in India and globally, particularly on the M&A side and capital market transactions across a wide range of industries. He's a chartered accountant and also a company secretary. So it's a rich panel, and without any sort of an ado, I'll leave it to the members to share their positions of where they come from in terms of approaching the bond market. Harjeet, could we start with you?
Sure. Am I audible? Hi, good afternoon. Thanks, Shalini, for the generous introductions. The panel might be rich. I don't know whether we earn richly as well or not. But that can be a separate discussion over the cocktails. Thank you for inviting for this panel discussion. As you very well know, we do not have any outstanding Indian bonds till date, although we are an avid participant in the bond markets in general. So maybe I'll start and I'll ask Nikhil and Pankaj to sort of add on what really is the need when we try and look at bond markets from a financing perspective. As any other economic theory works, when the need is very high, product class has little of use. So when you need financing really. So as you start into the evolution of the corporate world, we've seen for our smaller companies in the group, if financing is required to be arranged at a short notice, it is more or less a relationship financing. Local domestic institutions are very helpful. They go by relationship orientation. They see how the overall support or the credit architecture even loosely is working in the country around the sponsor supports. But as you evolve, you need to then keep thinking of more finer aspects of how really can you economize on 2 things. One is cost and the other is the available credit appetite. And I think from our perspective, our endeavors around both of these situations post our acquisition in 2010 of the African businesses, these objectives became very important. Financing was available. 11 banks had put together about $11 billion for us in that acquisition financing package. So it was running fine. It had to run 5 years of its course. Well, I think we were a little worried around, more preemptively so, that I think we are locked in for a higher cost, because as situations improve, our credit improves, we need to get down the credit spreads. And B, I think we have congested our banking appetite. So basis both of these things, we started evaluating why shouldn't we look at a non-bank financing vehicle. Now that indeed is something which you have to look for bond markets. And thankfully for us, we had one rating which was internationally an investment grade. The other rating was sub-investment grade, so we were split rated. So we took about a year to prepare ourselves, met investors globally, to understand whether these two objectives can be met. You don't want to go out and do an inaugural issuance which in a way is either lukewarm or does not succeed. So it takes a while, but our objectives were primarily driven to decongest the available banking appetite, move longer in the tenor, remove the hurdles of cost which we were locked in, reduce the cost up front, but is also open a venue in which you can actually continue to capitalize on reduction in capital spreads and our credit spreads. So that's the way we thought the need was. Thankfully, it has worked fine till date. Maybe I'll ask Nikhil from his perspective,
Yeah, sure.
how they thought on this particular account.
So, good afternoon, everyone. Well, Mahindra, I think most of the people know now, it's a $16.5 billion group. And while I will say that even the only bond that we have on the books today is the 50-year bond. So that probably says it all. Then if we went to the market, it was more for strategic reasons. It was not that there was a requirement of funds. We have probably not borrowed from banks for a long time. We sit on a huge surplus, so that's there. So cash need was not there. But then, of course, we need to be there in the market, and we wanted to see how long can we stretch the tenor to. So this is probably the corporate Inc.'s only 50-year bond which we could do. There was a lot of debate, why 50-year? And the internally also justifying a 50-year bond with a cost, of course, when we issued it and the way the interest rates moved after that, it turned out to be a very kind of wise decision for that moment. But then 50 years, if you're going to hold on to something like 9.5%, is it good? Something very important to debate even at the board level. And it took a while justifying it. But then the way we looked at it was a quasi-equity money. There was no put call, nothing. So today if I have to look at the equity money, it's not going to be so cheap. In pre-tax terms at 9.5%, you're not going to get it. So that's the way we try to look at the borrowing. That's the way we try to look at the bond market, to say that why not go out and do it. Why we are not regularly in the bond market? Well, the answer is simple. A lot of alternatives. You have ECBs which come very cheap. The spreads are so very narrow that even after fully hedging, I think it's much better. You have a lot of, but then having said that, the same problem doesn't come to when we have a group company. If you look at M&M Group today, we are in 18 industries. So we are in infra, we are in holiday space, we are in solar today, and all these companies do need borrowings. So it's not that the borrowing requirement is not there. But then the brand is so strong that is said there are many investors who can just come across and do a name lending, and therefore they are not required to go out and tap into the bond market. So if we are out there in the market, it's more for strategic reasons. It's not that there's a need for funds, but yes, it does help you try to discover what price you can get if you are there today. And the way we discovered at that point of time, it was at the rock bottom. When the rates went above 10%, we did it at 9.55, and for a 50-year. So that's the thing that I would say from Mahindra side.
Pankaj.
Yeah, hi, good afternoon. Let me present a slight and a fair amount of paradoxical view versus what we have just heard, because I'll be talking about more from an investing side, the way we see it at Kane. Kane, as you or quite a lot of people may know, we have a investable surplus of $4.5 billion, of which close to about 1.5 is there in overseas, in largely around foreign denominated bonds and all. The same bonds that possibly Bharti or SBI issues here, and the issuances that they are done abroad, we actually eat up or try to earn from the margin that is possibly taken up at the overseas level. The rupee side of $2 odd billion, we have got very limited options in terms of investing that into the right scenarios. So bonds which possibly could have given an upside is somewhat which is absolutely missing from an Indian context. We invest into foreign companies or companies which are the same Indian companies which are listed overseas. We invest into bonds of those set of units. So quite a paradox that what we see, from the issuance as well as the investing side.
So, I mean, it seems to me that, for you, it was a long, funding a long-term sort of finding a long-term source of long-term capital. And in your case, it was strategic reasons. And yours is a completely different view.
Yeah,
but
absolutely.
essentially, it seems the panel is pretty much, one of the largest companies, 3 large companies in India, pretty good financials, but you would not approach the bond market if unless it is for, like reasons, unless you're sort of, pushed to it, it seems.
I won't say that harshly, if I may use the word. I think there is nothing which is needed. When it is needed, it is not available. In financing world, you need to organize for financing when you don't need it. If you go out and say, look, I need financing, everybody is going to sit tight. So what happens in all of these situations, you'll have to preemptively keep thinking of options which you will keep open at all points in time, such that whenever there is a need arising, you have the ability to tap that source. So theoretically, and this is theoretically, I don't know whether we have press or somebody on the public side here, theoretically, if Bharti were to say that I want to go and acquire something in LATAM now, as an example. Okay, so there is no plan, please, just so that I don't propel any rumor. The ability now to have an established curve in the bond markets internationally gives us an overnight X billion dollars, which I would have taken probably 3 months in 2010 to stitch together the $11 billion that we did. Banks were telling us that we could do a bridge to bond and stuff like that, but obviously we were then placing our neck on the guillotine. So we want to have our options open. So I would say from our perspective, creating an alternative sets of windows which you can tap by creating a regular engagement, establishing a curve so that at a time when you need it, you can simply benchmark what is your on-the-run bond running at, and off that, how many basis points you want to eat away or take a benefit of. I think that's more important. The other thing I think it's important, at least in hindsight for us, I don't know how important today all of us collectively think, but in 2010 to 2012, you were seeing global deleveraging of all the global banks. They wanted to restrict their assets, specifically from non-US, non-European centers, reducing Asia exposure, within Asia reducing India exposure. Now, Bharti was one of the IG corporates, so you were getting good appetite. I mean, there was more appetite chasing for less number of corporates. But then you could see that the trend is not right. You need to be early enough to cite what is the alternate available, such that you're not forced into a situation someday, because we were predominantly overseas lenders counterparties. So we wanted to decongest the bank side more strongly. So I would say yes, on the domestic side it is not as easy, the domestic bond issuances. The rates do not necessarily follow a logic. He mentioned, Nikhil, if you take an ECB and fully swap it, I think 80 out of 100 times during the year you will get an opportunity where you can create a synthetic rupee bond or a synthetic rupee borrowing, which is much cheaper than the bond markets will offer you, even on a CP terms. So what that tells you that there is something amiss here. And that is where I think the group should collectively think of what are the governmental interventions, regulatory interventions, investor orientation changes, credit default swaps, interest rate futures. What all do we need to get this going? That is where I think today, we, as a market, domestically, we are limited.
And to build upon further to what Harjeet stated, more than decongesting of the corporate's need, it is also the need for making sure that if we want to build in an investment cycle back and make sure that the economy runs at a growth pace as we would have desired, a year back, that can only happen if the banks get either recapitalized to a great level, or we develop alternate sources. Stemming back to the point that he started off with, that alternatives are not only because we need it now. Alternatives are there because we badly need them now.
Sure.
So in that sense, my assessment would be that bond market, the nimble steps or small incremental steps that the government has taken so far need to be either accelerated on a whole hog level, and we need to leverage our abilities on the growth path that we have seen in the last few years to make sure that we rebuild on our capabilities.
To take it forward, if you see, there were efforts like CDS, but there is no market. Because 2011 we have started it. Now, even if I say that if for a group like Mahindra, if I have to make an issuance out of one of my subsidiaries, which will not be at the rating at which I am today.
Right.
Why do I do this? Because then I don't have a good investor who will come in. So then the bank becomes an option which you go to, or we ourselves have our funds which we can do. So that becomes a deterrent. If you have a good CDS market, you will have investors who are coming in. Today, if you have so many limitations on people who have funds. You have insurance people, you have pension funds, they can't invest. They have limitations on not more than 25%, 10% on more than say whatever rating, AA rating and above.
Right.
So these are again the impediments which come in. So probably one will have to look at how you relax this. If you don't want to relax it en masse, you can see how to do it for different groups, different companies, not in the sense I'm saying in terms of ratings. You can say that if the parent is rated X, you can probably see whether the group can then create it, something different, so that you just create a more bond market. You have asset reconstruction companies which can take only from a bank.
So so the point is essentially, I mean, you would much rather do a lot of other things rather than approach the bond market, at least in India, unless there are really compelling reasons for it. Recently, the government has, as Pankaj mentioned, taken baby steps in terms of, moving the corporate, the bond market entirely to SEBI, though those steps are not fully,
put into action.
Yeah. So in terms of, are you sort of encouraged by these steps, and how do you sort of see them? The FSLRC recommendations also have a very clear-cut sort of a roadmap in terms of where, the entire financial markets should be going towards a unified sort of a platform. So what are your thoughts along these
The key, as we said, is going to be the implementation. See, the point is that there are recommendations, but how good is the implementation going to be? Simple thing like a single regulator. I'm just saying that you have today multiple regulations which are there. You have IRDA, you have SEBI, you have RBI, everyone coming into play. So I'm just saying that can you have a single regulator? This one implementation can sort out many issues.
Sure.
See, generally policy formulations are directionally always good. It is how best and how quickly are those implemented.
Right.
Intent can never be doubted upon.
Right.
Intent generally is by far in terms of welfare. But as he mentioned out, if in case those steps are not executed well and timely, it doesn't really make sense. If we don't get back onto our investment climate now, we are derailing not only the economic growth, but we have seen the corporate earnings in the last quarter.
Right.
All that is getting impacted further by, it is, with the high level of leveraging, high level of interest costs. This is only going to blow up at some point in time.
So are we arriving at a point of, like no options, but...
No, I don't think it's as bad either. Just to first pick up on the earlier point. You see, the fact that, and he mentioned the intent is very clear. Intent is to facilitate further such issuances. Intent is to create further depth. Intent is to create a wide variety of investor pool which would want to invest in these bonds. The only challenge is, as he mentioned, variety number of probably competing objectives of the regulators who are involved here, who are then probably making it extremely difficult to have one single proposition go out. In an offshore INR issuance, what are you saying? You are saying, I will, and I'm using loose words, so pardon me for that, I will allow obviation of your registration process for the FPIs for the debt segment in India, and you can actually access the same thing overseas. Then why not ease the whole process here? Secondly, while you've done that, there is no clarity that the withholding tax, which would have been applicable if you were here, is applicable to that rupee issuance or not. If it is, then well, how does it change for me? Thirdly, on offshore rupee issuance, will make tremendous sense at a point in time when you have reasonably strong, if not fully, capital account convertibility. Now, there are not huge many number of rupee resources lying overseas. So which means the same investor will want to take a rupee call, so he's taking a dollar rupee, either a view or a hedge from someone else, which is offshore wrapped on the bond.
Right.
Now, this is something which is theoretically possible in the FPI investing in the debt segment or the corporate bond side already. So I think the intent is right, direction is right. The complexity with which we have to deal with in a rather vulnerable global financial climate is forcing the hands of some of these regulators who have competing objectives. Even on the equity side, the level 1 ADR has been allowed by the Sahu Committee about 6 months ago. We don't have the SEBI and the RBI clearances for the same till date. We are ready to actually get that thing rolled out for, let's say, Airtel or Infratel. Having said which, I think it's on us, on corporates like us, if we can, even if we can do 1,000 crore offshore INR issue, we should do it. Because that's the way to build this, get this started and get this going. So I'll be very keen if some bank can create a clear roadmap of what the regulation is on the tax side. But for that, nothing else holds us. We could do a $200, $300, $400, $500 million rupee issuance offshore. So at least get the whole thing going, create the awareness, create the buzz. People will follow.
Most of the corporates, I think big corporates will look for rupee issuances offshore. But again, if you see, there were of course the draft guidelines where people would have given their comments. The point is, why restrict it the end use to same like ECB? Make it as good as a rupee bond out here. If your end use is as good as a rupee bond over here, you get that much more flexibility.
Sure.
The other thing to add on is our government bonds. They actually completely are overwhelming. They outsize the private completely. It is 10 times the size that a corporate bond can possibly even exist of.
Right.
And it is almost half the GDP of the country. 50% of the GDP is really covered up by the government bonds, and only 5% or almost the same level is that of private. So this sheer number requires a major boost to make sure that the real growth happens.
I don't think we're going to get away from like large borrowings from the government for a bit. Any thoughts on the, like Pankaj, on your side, on the, since you also look out for, good issuances domestically. So any thoughts on, what are the constraints that you face in terms of,
biggest concern or the biggest bottleneck which can really, inch up or move the bond issuances in India is the platform on which they can be exchanged freely. Why can't, just like equity markets, why can't we have bonds which can be traded as frequently or as conveniently as we have for equities? We go in to these bonds through mutual funds, through AUMs, and we unnecessarily increase our costs. We are diminishing or making sure that these costs go up at their end as well. So this double whammy can always be avoided, and there are clear roadmaps. There are enough of examples globally that can be replicated here. So the competing interest which Harjeet brought about, good point, but that competing interest is also dwarfing the growth of the entire global cycle.
No, I agree. I think you mentioned the credit default swap. That is very important. Internationally, the liquidity of the overall bond market is because you could write a credit option and people could trade the credit underlying.
Absolutely.
And come back with the pure spread in their favor. I think that's serious today. If you were to go back to the objective of corporates to issue out bonds, is to decongest the banks. Now, unfortunately, in the domestic market, banks are the only so-called market makers. And now, if they can market make, they need to write trade spreads. These CDSs are blocked to, I think, 10% of their investment portfolio in non-rated bonds, which is a minuscule amount. And even that CDS is a part of their single borrower limit. So effectively, I have not decongested. If I use the domestic CDS market or domestic bond market, I have not decongested the banks because I need them to provide the CDS to the investors. There is, at least this piece can be brought out of the single borrower limited, and the 10% of the limit on the overall CDSs that you can write can actually also increase in the interest of developing the markets. For maybe better rated corporates to start with, AA or better, or a shallower limit for AA to A and stuff like that. I think that's where some bit of work still needs to be done.
So before I come to the audience, two questions on how long did it take both of you to sort of prepare for these bond issuances? What was the process? What were the pain points? Some personal experiences there.
Well, as I said, we have only one issuance, which is a 50-year thing, and over there, I'd say that the whole issue, it took us around 2 months to close it. But it was not more on the documentation and all that it took time. So it was also that it was a 50-year issuance, so there was more debate on how to do it, the investor base and everything. So that is what we wanted to debate, whether there will be enough market So that is what took time. But in terms of if you want to know whether procedurally it took time, I'll say that no, it didn't. It did procedurally did not take time because there is a standard sort of documentation and all which we had already prepared, which was already there in the past, which is kind of replicated in such cases for our corporates. So it's not something which takes enormous amount of time. But yes, the more time goes into justifying internally and all when you're already sitting on cash and you want to go out and borrow.
Yeah. So I think for us it was slightly different. Obviously the work involved on the investor side is huge always. Specifically when you're doing an inaugural issuance, you haven't ever met these fixed income investors. They may or may not have been on your equity conferences, but then in the equity conferences you are addressing the equity investors. So it's not as easy to have approached a credit investor, a PIMCO or a VAMCO or a GSAM to understand what they think about your credit. So it does take a lot of time to build the interest on the credit side for you to discover the price nicely. But I think that's natural. For us, the bigger challenge was internal. We had historically never done any bonds. So the first time when you do a bond issuance, you have to make sure everybody in the system, obviously in the finance chain number one, more importantly in the business chain, in the board levels, understand that this is the right thing to do. And our biggest hurdle was we thought that look, while we have taken a lot of debt after acquisition, fundamentally each year we are a free cash flow positive company. So in 3 or 4 or 5 years, if nothing else happens, we'll be zero debt. So why are we taking a 10-year bond if I can't prepay it? The prepayment option not being available in the bonds, and we talked about the whole bond document, how the Reg S works, 144A works. The convincing aspect internally to say that some bit of debt you will always carry, and that some bit of debt can be bond debt, was I think more onerous. Right? It took us about 2 or 3 board meetings, about 6-9 months to get that through. But we couldn't, shove close. So it had to be done more inclusively. Once that got done, about 3 to 6 months were taken on assessing the effort return. Effort was huge. You had 5 or 6 centers to be covered at least twice over before you did a formal issuance. But I think return was good because in one go you could do $1.5 billion. Unlike in India, if you do a great good issuance, it's like 2,000-3,000 crores of 3 to 5 years. So that was 10 years, $1.5 billion. So it just, I think there was a mix of internal and external issues. But I'm glad I think we are beyond it now.
And you've done it 3 years in a row, right?
Yeah, we started in 2013 March, and then December we did a Euro issuance. February we did February of 14 CHF issuance. Last May we did a dual barrel, single day dollar and Euro issuance. And 3 weeks ago we did another dollar issuance, about 6 or 7.
And Nikhil, you're also looking at an overseas issuance.
Well, as we are looking at international rating. And at the right time we will look at the international bond also. But as of now, again, it's something which we have yet to take to our board. And hearing his experience of 6 to 9 months, it worries me also how long it's going to take with my board. But then definitely I think it's something which the group, when it's going to grow globally, today we are present across most of the geographies.
Right.
You have exposures outside, so an international bond, international rating definitely makes sense.
Right.
And this is the right time to do it also for a corporate like us.
Right. With that, I'll throw it open to the entire room. Any questions? Sorry.
Hello.
Could you please identify yourself?
This is Ashok here.
I'm Mahapatra from Abhyuday Bank, Bombay.
I've come from Bombay. I just now we were discussing the bond market is not that liquid. It is known to everybody, but what you feel the main reason? Is it the multiple securities available in the same segment, like state government loans and all, or something else? Or you are looking at a single regulator to control all these aspects as you were discussing? I am surprised why it is not liquid in the market. Why there is no liquid market for bonds? What I mean to say, just like equity market. You were pointing out just while discussing. But what is the reason, according to you?
I don't know, maybe I can take a quick shot at it. Look, as many number of issuers and investors is what will make it liquid. Number one. First of all, you need to have diversity of possibilities for the investor. We have one investor here. and a lot of issuers in the system. Issuers need to be across the rating categories. So there needs to be investor interest across the rating categories of issuers as well. Then you need to have a regulatory climate which allows such issuances and investors to be able to participate in that. In the regulatory climate, I think the 2-3 things which are important. So I don't want to lump everything on regulation because it's not true. Not many issuers are taking that path because historically India has been evolving on relationship borrowing. And that is the best way of a sponsor-led, relatively new in evolution corporate or an SME or a mid-market to access financing today. We hate to say that I will have a non-relationship lender in my basket because I don't know how my business outlook is looking. So we have to come out of that cusp today. So diversity of issuers, plethora of investors where we have obviously problems on account of our dollar-rupee rates, the wholesale debt segment including investments in corporate bond segment being capped for certain amounts, not below certain number of years. All of that needs to be eased out. Taxation is an issue, the third one. Credit default swaps we mentioned, I think it's another one. Why can't a corporate bond be used as a repo? It should be allowed as an underlying for a repo. Even our GSECs don't clear and settle in the Euro clear or the overseas developed market settlement mechanisms. If they go there and slowly because of the fact they are going there, Indian GSECs itself become a part of the indices, global bond indices. You have amazing amount of interest coming back to India, which then slowly piggybacks for corporate issuances as well. So it's a set of all these things coming together. And it's not that only one area is lacking. But yes, somebody has to push it through. A single corporate may be wishing to put a list of requests to someone, but that someone will then need to be able to articulate these objectives, gather support around constituents and get things going. But all of these matter.
The corporate repo, of course, is important. The second thing is M2M. It's a simple accounting thing, but for an investor who has to... Corporate? But it's not, I don't think there is a central settlement agency which guarantees on both the sides.
Banks are allowed to do it.
Liquidity going to come now?
It is not that liquid, but it is allowed. I think RBI has allowed it.
It's also a chicken and egg, right? So there is not enough number of corporate bond issuances of a certain category, which then form as a collateral. So all of that is a process of evolution. I think it will come there, but it's
when you look that is supposed to come.
We are hoping earlier the better.
For last 3 years,
also,
I think this.
I'll also introduce a little provocative thought out here. Also, do you think a lot of Indian corporates are also comfortable seeking bank loans and other relationship-based funding because
that is the easiest to have.
Because they can also sort of renegotiate the terms in hard times.
Yeah, no, without doubt. I think that's
without doubt prepayment.
Defaults would really sort of mar your image completely.
Yeah, I mean, at least from our perspective, I won't say that we had any danger of defaults and or anything on the adverse trying to force us to go to the relationship market. But yes, the ability to have bilateral conversations to restructure something if needed be, I think that was more stronger historically. But we've realized that the window you close or partially close, but the window you open are disproportionately different. And once you've done that, it's like, which is why we have continued to increase our bond stock. Now our bond stock is about 1.3 times our EBITDA, which one could argue is probably just about the optimal debt you should have for a large company like us. So in a way, you are changing that paradigm, and we are realizing that changing that paradigm was better. So happy to share experiences with others who think, in a way, it's taboo to sort of look at bond markets because we are non-relationship lenders. Having said which, I think the terms are also not as good. Investors are all looking for yield pickup. I'm looking for yield benefit as an issuer. Then I need a relationship climate to continue. So actually, I have my arm around the AUMs, saying you will invest in some certain such corporate bonds only and not anymore. So I think it's a little more complicated today. It is easing out, having said all of that. It is easing out. Offshore INR issuance, domestically people like Mahindra and Mahindra are doing the way they are doing. We've discussed with some of the fund houses who we are also investing in. We've got about $1.5 billion on the investable surplus. We've said, look, my problem in issuing a domestic NCD is that I don't want to take a fixed rate call. And I don't have the underlying fixed to floating market, because fixed to floating is on MIBOR and we don't understand MIBORs. We are non-bank participants. We are corporates, we understand base rate. So unless base rate reaches a level where it tracks MIBOR, or I get a fixed to floating swap to base rate, it's difficult for me to compare. So I empathize how could they figure out 9.5% was right or wrong for 50 years. Because you need to project a base rate borrowing which you had for 50 years and see whether this was right or wrong or who is getting benefited. So that I think is a stronger concept. We are discussing with these mutual funds. They are very happy to structure a customized bank rate based issuance. So people are willing, the issuers are willing, the investors are willing. I'm sure the twain will meet someday.
So the flexibility that comes with the bank loan, as you said, see below AA rating, you have no choice almost. You have to go to a bank loan. Right. And when you are above AA or you are a very strong company, your negotiating power is very good with the banks. That's what is kind of, I'm saying, acting as a deterrent also to our bond market over here. The option of an international bond is much more exciting than getting into a bond market in India today.
Pankaj, on your
Yeah, just to add to the other panel speakers. You know, the other thing which is ailing, or which possibly is one of the downside, is not having a right platform. Unfortunately, whatever we have spoken about, whether it was government regulation or strengthening or leveraging the credit rating, agencies, reports and all that is good to have. But the real thing is, once you start to have retail participating in the action, that is missing. While that may not constitute to be a good, a fair amount of chunk of the overall issuance, but that composition would really drive back the, the mood around it.
Any other questions?
The operational or the regulatory part?
It's a mixed bag. Regulations have...
As you said, even the retail could add to that liquid and more, it can make it more flexible and all. Right. So that's my question, it's more on the operational part or the regulatory part, like as you said, AA, AAA ratings, all those things. Are there any hindrances?
So there are definite hindrances. Like, even if, as you were rightly mentioning out, you would not find any bond emissions of any company which is either not AAA or AA+. Anything beyond that is virtually not possible. So the only option left to them is approach a bank. The other thing is, you can only approach through OTC here. That level of width and distribution is the key for growth. So it is a mix of both having a regulation, ease out. Take for example, the banks, they give you a very generous period to term anything as NPA. However, if you default even for one single day on a bond issuance, it is classified as a default.
True.
So the terms, the turf is very, very different. It is, taken up on a very, very stringent form when it comes to the bond issuance side.
I think the standardization aspect, which could be operational, is probably more enabled by regulation. Getting more number of investors is again to a certain extent more regulatory enablement, because it has got FEMA involved, it has got tax involved, it has got RBI involved, it has got dollar-rupee fluctuation involved. But I think the question on issuer side is, and she mentioned very right, there is a certain amount of block which needs to be released. So a corporate who is, let's say, single A rated can actually get a structured rating by some credit enhancement and can issue a bond. But the flexibility which they lose, they tend to fear that this is probably not the right time for us to do it. We should do it when, we are rather strong in the credit rating. So that market of that particular so-called, let's say, sub-investment grade issuers is not evolving faster as well. So we also, I think issuers also need to be carrying a stronger discipline around not fearing such things. And lastly, the sum total of all the friction cost in the system is such that credit enhancement plus the cost of issuance may end up being costlier than the relationship loan. Then it defeats the purpose of trying to urge somebody to be a little bold.
But there have been, Harjeet, people who had these high-yielding bonds. So some of them have ventured out.
Without doubt. I mean, I saw the perpetual issued by Utkal. It's a great deal. So innovation is happening. I think the CMBS market is picking up. For our real estate company, we're looking at a CMBS potentially, because you have a lot of lease rentals. They create the annuity pool, which gives the right collateral, so credit enhances the overall issuer's rating. And the structured rating can get you a very good rate. So all of these are happening, bits and pieces, in pockets. I think there is more liquidity which is required over time. And for secondary liquidity, I think the CDS pieces or EPFO today cannot do more than 10% in bonds. And now if they do it in bonds, they cannot sell it unless it's a credit rating event. So it's not right. So I think slowly all of these things will also need to co-evolve.
Any other questions?
Yeah. This is Ashok Sharma from Himatsinka. While we've seen in Hong Kong and Singapore unsecured bonds, in India it's not so much evolved. So maybe can you put your thoughts on that?
I think whatever we said just now, that regarding absence of the CDS, absence of the investors in terms of there are limits to your people who can invest into rupee bonds over here, like if you take insurance, if you take pension, you take provident fund, these are the guys who have money. If they have to invest into your bonds, they can't go below a particular rating. Then who is going to invest into the bonds over here? Below, as it is, your AAA becomes for an international person even if they have a BBB minus, it's a sovereign rating. It's a last investable rating for them. So if you have to go below AA, who is going to be there? Where is the investor?
Yeah. And senior unsecured market in India is very right, is AA plus AAA. So if senior unsecured lenders are the banks, if they themselves become the investors on the bond side, it doesn't change anything. You're just changing the route of access, and for maybe some arbitrage, if at all. So if you need to access these investors who have different ways of risk rating the asset that they are investing in and thereby put capital, security allows them to take an easier call on you, because they will risk rate it slightly better than the unsecured, and the capital allocation being lower, they can price it better for you.
And even if you look at banks, only probably 2% of their things is in corporate bonds today. More than 60% is credit.
I guess
Just from a standpoint of a dipstick, it will be useful to get a show of hands in terms of how many people have accessed the bond market or are considering it.
that says it. So, but you know, there's a lot of reward for the bold, and as Harjeet put it, you know, you may close one window, but what you open up is like a very, very long source of long-term capital. It's very reliable, I guess, and you know, it's worth taking a risk on.
Would our panelists, given that you're all a part of the bold brigade, give some advice to people in the room in terms of how to think about this, just before we close?
You know, I definitely am not a part of that bold group because my portfolio does not have even a single iota percentage attributed to Indian bonds. So that is the state of things.
But Pankaj, you mentioned about how, you know, as an Indian company, as a company stationed in India, you are best, you know, positioned to sort of evaluate Indian risk. And, you know, it's a travesty that you do not have that option.
It is an unfortunate thing that we know State Bank of India. I mean, if it defaults, the country is going to come to a standstill. The same SBI bond, we, you know, buy it overseas and get a far superior yield. You know, I mean, that throws upon the mockery of the state of things here.
But I don't know, not as an advisor, and rather to come back to your point, I think the only thing which we thought which worked for us was making sure ahead of time, look for alternative windows of financing. And I think it doesn't matter, it has to be a bond market, it could be, for all you know, an ECA financing, it could be a Japanese, you know, a FLAC. Just look for alternatives to the way you have been financed in the past 4 or 5 years. So we started presenting in the board in 2011 June what we call as diversity matrix, of diversity of just the sources. It had no cost written on the right, just the diversity of the source. And we said 100% banks, 100% banks. Third quarter we were itching to say, how can we change it? We brought an ECA deal done, okay, 6.5% ECA financing. Slowly you started diversifying that box. You realize that you are now looking more aggressively at what all could you access for potentially providing a source of financing. That's where the bonds came in. Now, I'm glad it worked out, but I'm glad even if it wouldn't have worked out, we would have had more ECAs, something else domestically, for all you know, maybe from the mutual funds or a retail, you know, ICD or something like that. All of these are possibilities. My advice would be only preemptively look for alternatives, build for that, something or the other will come by. It's always useful.
So he has probably said it in a right way. Look at diversity, which is a good way to look at it. Having said that, probably the only thing which you need to additionally look at is, as the another view which was put, it's a market where you cannot kind of default, you don't have much flexibility. So you need to be very clear on your balance sheet, your cash flows going forward, And if that kind of supports the decision that you are taking, then definitely it's a market which we should not stay away from.
So I guess that's a wonderful way to close. Thank you so much
Thank you
for a wonderful discussion.
Thank you all. Thank you.